Welcome to the deep dive. Today, we're really going to cut through the noise, get behind the headlines.
Exactly.
We're diving into the latest economic picture from July 2025, using the month that it was, report from the Macro Butler,
Great source.
and, well, what looks straightforward, like good news maybe, often has this deeper layer, right?
Absolutely. There's always more to the story.
So our mission today is pretty clear.
Yeah.
Get you the core insights, the stuff you really need to feel informed, maybe even spark a few aha moments.
And connect the dots, right? See how these different pieces of data, these seemingly separate trends, actually link up to form the bigger picture.
Yeah, challenge those common narratives.
Encourage that critical thinking, because headline numbers, they rarely tell the full truth.
Okay, let's jump right in then. Segment 1, the job market and retail. June looked, well, pretty fantastic on paper. Big surge in non-farm payrolls, unemployment went down, hourly earnings cooled a bit, which calms some nerves, and a nice jump in full-time jobs.
Well, it's like victory lap material for sure.
Exactly.
And so what's the catch?
Well, here's the thing. You peel back that headline number, and you see where the jobs actually came from.
Okay.
Primarily taxpayer-backed sectors. We're talking education, health services, government. Those were the drivers.
Not the private sector.
The private sector was, let's say, lagging, definitely not leading the charge, and part-time jobs actually decline. So it points towards a labor market that's maybe a bit more rigid, more state-driven, less organic private growth.
Okay, so that was June. Then July's jobless rate came in lower. So did hiring suddenly pick up steam?
No, that's the twist. The lower rate wasn't because of more hiring.
Then why?
It was mostly because the labor force actually shrank. Fewer people looking for work.
Ah, okay, that changes the picture.
It does. And on top of that, the average work week got shorter, contracted.
So even if wages went up a bit, people worked less income overall.
For many, yes. It offset wage gains, less overall income for a lot of folks. And here's a key historical flag, something you really need to watch.
The unemployment rate. It's been above its two-year average consistently since September 2023.
And it's significant.
Historically, yes. Very reliable precursor. Usually points to an economic downturn within, say, 12 to 24 months. It's a quiet warning signal.
Wow. Okay, definitely can't just read the headline there. All right, let's shift to retail sales. June saw a rebound rate, up 0.6% after May was down.
Yes, nominally.
Autos gave it a boost, but even excluding autos and gas, sales were still up 0.6%. The control group, which feeds into GDP, up 0.5%. Restaurants, bars improved too. Sounds healthy.
It sounds healthy, but again, it's that classic case. Nominal strength masking real weakness.
Meaning inflation.
Exactly. Adjust for inflation. And June sales are barely above last February, still way off the peak from April 2022.
So, running in place, basically.
Pretty much like running on a treadmill. And look at the S&P 500 to oil ratio.
What's that telling us?
Historically, that ratio falls below its 7-year average before a recession hits.
And where is it now?
It's doing exactly that. Flashing warning signs, Wall Street just doesn't seem to have fully noticed or maybe acknowledged it yet.
Okay, cracks appearing beneath the surface. That brings us to inflation and the Fed's elusive 2% target. Is that still just a fantasy?
Well, June's CPI data kind of burst that bubble, didn't it? That dip we saw earlier, looking more like a mirage now.
Still sticky then.
Oh, yeah. Holding at 3.0% year over year. And tariffs, they're definitely adding fuel to that fire.
So, reaching 2% by year end.
Requires near zero or even negative monthly prints from here on out. Statistically, it's basically a pipe dream.
Right.
If inflation just keeps chugging along at, say, 0.2% by December, which is pretty modest,
We end up where?
we could easily be looking at 3.4% to maybe even 5.3% by December.
Wow, okay, so forget rate cuts then.
I would hold my breath. With inflation this persistent, there's really no strong case for cuts.
Could they even hike?
Honestly, a hike before year-end is looking more likely than the market wants to admit right now.
That's a big shift from where expectations were maybe a few months ago. You said consumers are footing the bill for inflation. What about companies? Are they absorbing costs?
That's the interesting part for equity investors. June's PPI, the producer prices, came in flat. Looked okay. But May's core PPI, stripping out food and energy, got revised higher from 3.0% up to 3.2%.
Indicating?
Persistent price pressures building up behind the scenes, that whole disinflation story, it's on shaky ground.
So companies are just passing costs on.
It certainly looks that way. Corporate America seems to be successfully passing rising input costs straight to consumers. That's protecting their margins, supporting earnings.
How can we see that clearly?
Look at the spread between core CPI, what consumers pay, and core PPI, what producers pay. In June, it turned positive for the first time since last September.
Meaning?
Companies aren't absorbing the tariffs or other cost hikes. You, the consumer, are.
Okay, so companies are managing, but our wallets feel the squeeze. Let's pivot to something often called safe, U.S. Treasuries. Risk-free, right? Or is that just an illusion?
It's a label that gets thrown around a lot. Risk-free. Wall Street, media, they've hammered it home for decades.
But you're questioning it.
You have to. Since the dollar left gold in '71, bonds became the go-to safe asset, the global debt market. It's ballooned over $300 trillion.
Okay, huge number.
Now compare that to all the gold ever mined, value. Around $22 trillion, less than 7% of the debt figure.
That's a stark contrast.
So here's the real question for you, the investor. Where's the real safety? In politicians' paper promises backed by ever-growing debt, or in centuries of preserved value, like gold?
Puts it in perspective.
Definitely. And, decades of, let's be frank, fiscal recklessness, monetary distortions.
Yeah.
It's led us to a kind of breaking point.
And this new big, beautiful bill?
Just the latest chapter, isn't it? More spending, more debt, more promises, often empty ones.
Are the markets signaling this?
The bond markets are, not equities so much yet. Rising yields, even when people talk about easing, synchronized sell-offs, it screams warning. And there's the quiet default, too. Through inflation. Eroding the actual value, the purchasing power of that paper money and those bonds.
That's a chilling thought. And the government's strategy for managing all this debt. I hear they're rolling the debt dice with short-term bills.
Yeah, that's the approach. Even before this big bill, the administration signaled a preference for issuing short-term treasury bills instead of locking in longer-term debt.
Why do that?
Well, it gives a short-term juice to something called reserve velocity. Can lift stocks for a bit.
But the downside?
Big downside. Massively increases rollover risk. They have to keep refinancing huge amounts constantly. Makes the whole system more fragile.
So it's like using a credit card for groceries when you're already deep in debt.
Yeah.
Short-sighted. Risky. And while Washington plays this game, gold just sits there, potentially gaining as confidence erodes.
Okay, and where do stablecoins fit in? Future of finance or part of the problem?
The Genius Act. This paves the way for regulated stablecoins tied directly to U.S. Treasuries.
Sounds innovative. Or maybe it's less about innovation and more about creating captive demand for treasuries. A stealth way to prop up the market as traditional buyers, like foreign governments, back away.
So a de facto CBDC almost.
It certainly moves things in that direction. More surveillance, less cash. And yeah, positioning stablecoins to absorb government debt.
Is it working? Containing yields.
Well, the stablecoin market cap has grown since January 25, sure, but it hasn't stopped long-term treasury yields from rising. Digital wrappers don't fix underlying confidence issues.
And gold.
Look at the negative correlation between USDT, a major stablecoin, and the gold-to-bond ratio. It suggests gold holds value while these digital solutions and political maneuvers play out.
Really interesting dynamic there. All right, let's talk Fed. What are they going to do next? Are rate cuts actually happening this year, or is something else cooking?
If you look at the Taylor rule, which is a common guide.
Right, based on inflation and unemployment.
Yeah. With core PCE at 2.7% and unemployment at 4.1%, the rule suggests the Fed funds rate should be near 5.92%.
Way higher than the current 4.50%.
Exactly. So while the Fed's own projections, the dot plots, still show 2 cuts this year, and the market expects them in Q4.
The reality might be different.
Could be very different. If we tip from this inflationary boom into more of an inflationary bust, stagflation territory.
They might have to raise rates.
It's definitely on the table. They could be forced to raise, not cut.
Wow, that would shock the markets.
Absolutely. And there's another piece here. The Fed's invisible hand seems to be returning quietly.
Meaning?
After tightening liquidity for almost a year, shadow liquidity is actually expanding again.
Wow.
Mainly drawdowns from the Treasury's checking account, the TGA. That account is low, and the reverse repo facility is dwindling too.
So the Fed might have to step in.
They might be forced to reopen the liquidity taps soon, inject cash. And if market volatility picks up, which seems likely,
Then what?
it increases the odds of a liquidity Fed put. Basically, the Fed steps in to provide liquidity, stabilize things, especially heading into Q4.
This whole scenario, it feels a bit like the 1970s, doesn't it? Are we seeing kind of gold's 1970s redux?
The parallels are getting harder to ignore. Since 2022, central banks worldwide are rethinking their dollar holdings.
Why?
Concerns about Fed independence, politics creeping into monetary policy, a potentially weaker dollar, and even small shifts matter.
Now say.
JP Morgan estimated that if just 0.5% of global assets shifted from the dollar to gold, it could push gold towards $6,000 by 2029.
It's a huge move.
It is. And 2025 has already been good for gold, right? Trade tensions, geopolitics, talk of new currency systems. It all reinforces gold's role.
And the 1970s connection.
Runaway deficits then, runaway deficits now, persistent inflation then, persistent inflation now, a Fed feeling constrained then, a Fed feeling constrained now, gold soared in the 70s. This time, it could be even more dramatic.
Okay, that's a really strong historical echo. So pulling it all together, jobs, inflation, bonds, gold, where does this leave us in the big economic cycle picture?
Well, technically, as of late July 2025, the U.S. is still in that inflationary boom quadrant.
Yeah.
Been there since about May 2023.
And what works there usually?
Historically, equities and gold tend to do well in that phase. But, and this is a big but,
Oh.
the S&P 500 to gold ratio, it broke below its 7-year moving average back in late January.
And that was bad.
Historically, it's never been a good omen. It usually precedes the S&P 500 to oil ratio breaking down by a few months.
Okay, and if that ratio breaks down?
That signals the shift, the move into an economic bust phase. Stagflation.
So if that bust is coming, what should people be thinking about for their investments? What's the practical takeaway?
Once that S&P 500 to oil ratio drops, the playbook shifts. Every equity rally becomes more of a selling opportunity.
So sell stocks. What about buying?
You shift focus. Look to buy dips in energy producers. Sell strength in energy consumers.
And generally.
Focus hard on quality companies. What does that mean? Low debt, low refinancing risk, high return on equity.
Why those?
Because those are the companies that can likely grow earnings and cash flow faster than inflation. That's your defense in that kind of environment.
What an incredible tour through the month that it was July 2025. Really underscores how the surface story isn't the whole story. Weakness underneath, stubborn inflation, bond warnings, gold making its move.
Yeah, to really boil it down for you, first, tariffs and wars. They're stagflationary. Prices up, growth down. Simple as that.
Yeah.
Second, that 2% inflation target. Think of it as the new floor, probably not the ceiling anymore, which means long-term bond yields likely head higher unless the Fed does something drastic like yield curve control.
Okay.
Third, the 2020s could really start looking like the 1970s, a lost decade for just passively holding broad market indexes.
Right.
Fourth, keep an eye on that shadow liquidity and these new tokenized debt things like stablecoins via the Genius Act. They're propping things up, but add complexity and risk.
And the action.
Your anti-fragile tools, the things that can potentially withstand or even benefit from this kind of stress, this inflationary bust or stagflation. Physical gold, silver, hard assets with limited supply platinum, oil, base metals, ag commodities, long-dated government bonds. Be very, very cautious. Maybe avoid them.
So the final thought for everyone listening. Knowing all this, how might you reconsider those safe assumptions you hold about your investments? And what new opportunities or maybe risks does this deep dive into July 2025 reveal for your own financial outlook?